All right, let's go ahead. We hit that noon hour. We'll go ahead and get started. Good afternoon, everyone. My name is Saray Helms. I'm the Community Relations Specialist here at Greater Nevada Credit Union. Joining me are a couple of my teammates, Leslie and Stephanie, and they'll be helping answer questions and be in the chat room, so feel free to reach out to us. I do want to thank you guys for joining us on this recorded presentation. For now, we'll have you guys put yourselves on mute until the Q&A sections. Greater Nevada is finding a growing need for financial education for our community members. Each month, we'll be showcasing a financial topic that we hope will help our community move towards financial wellness. If you're interested in learning more about these webinars, please check out our website at gncu.org and search for Greater Financial Wellness Hub. Today's presentation is on home buying or purchasing a home. And I would like to introduce you and get to know our presenter, Danielle Kirby. Danielle moved to Northern Nevada in 1994 and became a regional sales manager with a large company. In 2000, Danielle obtained a real estate license and quickly became a top producer. With this background, Danielle understands the intricacies and importance of the real estate purchasing process. She's committed to providing her clients with world-class service and making their purchase of refinancing or home buying an easy and stress-free process. Danielle enjoys an active lifestyle and has competed in many marathons and triathlons, including the Lake Tahoe Ironman event. Go Danielle. She loves to be outdoors, travel, and spend time with her husbands and two sons. Welcome, Danielle.
Thanks so much for having me. I love doing these classes because having real estate knowledge plus the lending side really helps our members, I think, understand the process better and hopefully make it not so overwhelming. So let's start with homeownership, right? Everybody wants to get in the game because owning a home is the big American dream, and everybody's like, I'm tired of renting, rents are going up, I want to buy a house, or I want to get out of the current home I'm in and, you know, potentially transition into a larger home. So let's get into this today. So if you learn one thing today, hold on one second. So if you learn one thing, it's no home is worth being house poor. So a lot of people, when we first start talking about what goes into a mortgage and what components make up your house payment, there's several factors that go into it. And not only do you have your loan, but you also have your property taxes, your homeowner's insurance, and you know, if you have less than 20% down, there's mortgage insurance. And then there's things that are not part of your mortgage, but they're part of owning a home. Your monthly water bill, your monthly electric bill, your sewer bill, your trash bill. So there's a lot that goes into owning a home besides your mortgage payment. So one of the things I tell people is, you know, we want you to own a home. We don't want you to be shackled by owning a home because, you know, things that you enjoy, such as Starbucks, going out for dinner, whatever that may be, we don't want those things to go away because you're shackled by owning a home. So my job as a lender is to make sure that I'm pre-qualifying you in such a manner that you're owning your home isn't owning you, and that you can still do the things you love. And when you pull in the driveway every night, when you get home, you're like, I am so excited I'm in this house. I am better off than what I used to be. So what is the lender looking for? So often people are surprised about what they can get approved for, but it doesn't mean that you should get approved for that much. We want to pre-qualify you, but we want you to make sure that you're within your parameters that work for you, that you can still live your life. So what are the big four factors when I'm pre-qualifying someone to purchase a home? Okay. The big four are FICO, credit score. Everyone's fixated on their credit score. I'm sure a lot of you guys probably have Credit Karma on your phone and are monitoring your score. Just a little note to self, remember Credit Karma is an advertising agency, not a credit reporting agency. So often there's a discrepancy as to what is on Credit Karma versus what your actual credit score is. So we actually use in pulling your credit, we use the big three. We use Equifax, Experian, and TransUnion. That is what is required for a mortgage. The next thing we're going to look at is debt to income. How much income do you make and what are your total liabilities? Do you have a car payment? Do you have a credit card? What liabilities do you have? Is there student debt that you're dealing with? What is it that you have that factors into that debt to income ratio? Because we're going to allow about a 45% debt to income ratio, including your mortgage payment, to get you pre-qualified. Loan to value. How much do you have to put down versus the purchase price? Are you a first-time home buyer? There are products out there where you can put as little as 3% down. Are you transitioning into a home? Do you want to maybe pull the equity from your current home? You have 20% down, but maybe want to put a little aside for fixing things up. All of this goes into your making up your loan to value. How much equity do you have versus how much debt you're taking out? Debt to income, I touched on that, the liabilities versus the income you make, and then your reserves. That is a compensating factor. If you have, 6 months reserves, your lender is really going to like that over I'm scraping by every single month, right? So, what does this mean when we talk about the big four? What does this mean to you guys in terms of what to expect in getting pre-qualified for a home? And with all of these factors, there is paperwork because the lender is saying, how much risk am I taking on by lending to you, Mr. or Mrs. Smith, right? So the name of the game throughout the process, and this is the overwhelming piece when you're buying a home, the name of the game is paperwork. So I'll often have people sit down with me and say, okay, do you have everything you need? And I often tell them, yes, I do, until tomorrow, when the underwriter or the processor or whatever needs another piece of documentation. I often tell people, I will need your blood type, your shoe size, a hair from your firstborn. I kid, but it often feels like that. So remember, in getting pre-approved, the name of the game is paperwork because of the risk associated with getting a loan. I just went over a lot of information. Does anybody have any questions so far?
Hello, I am back. I just wanted to welcome you guys. We do have a few question breaks during this presentation, and this is one of the benefits of being here is we have Danielle, a mortgage consultant right here, so ask those questions. We welcome you during these question breaks to come off of mute or type in the chat, and I will be happy to interrupt Danielle either during these question breaks or when it's relevant. And we do have one come in. How much do we need in our reserves? Does our down payment count for this?
No. So typically it depends on what type of a home you're buying. If you're buying an investment property, you're going to need 6 months of reserves, and that is above and beyond your down payment. When you are a first-time home buyer, or if you're not a first-time home buyer, you're buying in the jumbo category, which means your loan amount is over $647,200, you're going to need 6 months in reserves, and your down payment does not count. So, but again, there's unique situations where you need those, which is what I walk you through.
I love this next follow-up question. Can I use my 401k as a reserve, or can I count my 401k
100%.
towards? Okay,
The other thing
great.
that's really neat about 401ks is that in certain circumstances, you need to call your 401k company, but often you can borrow from yourself from your 401k and use that as a down payment without a tax penalty if you're agreeing to pay yourself back. So that is a great question. And yes, 401ks come in to play a big role if that is something your 401k allows for.
Perfect. Thank you, Danielle. Another one on the top of paperwork and documents. Are the documents we provide evergreen, or will we need to resubmit them again through the process?
Evergreen. I'm unsure of that. But so one of the things in getting pre-approved, and this I think comes up later in the presentation, but I'll touch on it right now, is your pre-approval is good for 30 days. Why? I need 30 days of paycheck stubs. I need 60 days of asset statements. So as you go through the process, 9 times out of 10, when people get pre-approved, they don't have a house in mind. They're going to go out and look for a house. And oftentimes that process can take 30 to 45 days. So again, let's go back to that paperwork slide. I'm going to consistently be asking for updated docs to make sure your pre-approval is still good and hasn't expired. So once you submit, like, for example, your tax return to me, that I don't need it to be updated, but then paycheck stubs, asset statements, as time moves on, that stuff I do need updated.
Perfect. Thank you, Danielle. I think that is all the questions we have for now. And that's actually where I was going to ask you to kind of add on to it, is that pre-approval and the process of the paperwork through that. So thank you so much. I think we're good to go now.
Absolutely. Okay, on to my next slide, if I can get my mouse to work here. Okay, so the one question that I get asked all the time is, what is your interest rate, right? So interest rates, and I find this fascinating. We get a new rate sheet every hour. People think, oh, well, what's your interest rate today? Well, it can change. Interest rates are not set in stone. There can be something crazy go on in the market, and we'll watch interest rates react accordingly. So there is no interest rate that Greater Nevada has, because interest rates are dependent on the borrower. Again, those big 4 that we talked about, your FICO score determines your interest rate. Your loan to value determines your interest rate. And so this is one of the most understood parts of the home loan process, because again, interest rates are unique to each individual and their own situation. So oftentimes you will see people advertise interest rates, get pre-approved, 30-year conventional fixed interest rate from, 4.5%. Well, that's a teaser rate to get you in the door, because no one can say that they can guarantee you that interest rate. It goes back to each individual unique borrower, and all of us are unique in our own ways. So none of us are going to get the same interest rate unless we have the exact same factors in our application, which is rare. So there's always going to be a little bit of a variance between each borrower. So again, interest rates as a borrower are determined by loan to value, debt to income ratio, and FICO score. What does it mean to lock an interest rate? So typically when let's say you've gotten pre-approved and you're going out with your real estate agent and you find a house, you make an offer and it gets accepted. So then you come back to me and you're like, okay, Danielle, here's all all my updated stuff that you asked me to bring. What are rates today? Locking that interest rate, and we'll have a conversation, from the time you get pre-approved to the time that you actually find a house about how interest rates can change up or down. Locking in your interest rate is saying, I want to lock this number because I'm comfortable with this payment, and that protects me in the event interest rates go sky high. But locking also means that if the rates go down, you're still locked at that interest rate. And that goes into a whole sort of secondary market thing. But that's how banks are able to sell interest rates, because they've got it locked in and they know they have a pool of interest rates at this. So again, locking means I'm guaranteed this interest rate through my transaction, whether rates go up or whether rates go down. So, and I will say, floating your interest rate, you can do it, but I don't suggest it, only because what you know today is better than the unknown of tomorrow, in terms of, oh, wow, if it goes up, now I just am not qualified anymore because I can't afford the payment. So that's how sort of interest rates are determined. And it's really not about what my interest rate is. It's about, what is your interest rate as a borrower? What situation are you in? What applies to you? And what rate will you be offered as your own unique person? And I feel like I just gave a whole bunch of information. I know this isn't a question slide, but are there any questions about what I just went over?
I do have a personal one.
Okay.
Thank you for asking, because I think it is relevant to this last slide. When does a rate lock in?
When you tell me to lock it in.
Okay,
So
thank you.
yeah, so that's really all it is a conversation. Yes, I want to lock my rate at this. Danielle, go ahead and do it. And then I take care of that. So that's sort of what I'm doing. And I'm watching that stuff. And we've had a conversation about where rates are going. And we all know right now, rates are going up. The feds have announced it. They're battling 8% inflation, and I think rates are going even higher. And I see that, how far out can we lock our interest rate? So a 30-day lock is going to be the most cost effective. The longer you go out in locking a rate, the more expensive it is going to be for the borrower. We can go out as far as 90 days. I often don't recommend that, because you're paying a lot of money to lock that rate for that long. Things could change, things could go down. 45 to 60-day locks are what I recommend based on your contract timeframes. So all of that stuff is in the initial conversation when I get you pre-approved. So let's move on to the products that there are out there available to everyone. So a conventional loan means my loan amount, not your purchase price. There's a difference between loan amount and purchase price, which is what makes up that loan to value. So my down payment, so the purchase price less my down payment is my loan amount. So a conventional loan amount is any loan for $647,200 or less. Yes, $647,200 or less is a conventional loan. Government loans are FHA, VA, and USDA. USDA, the property has to qualify. It has to be rural, and then it's considered a USDA loan. FHA is secured by the Department of HUD. And then again, VA are those veteran loans. You have to be a veteran in order to qualify for that. And then jumbo is a loan amount, anything above that $647,200. All of these factors. So in determining what loan is best for you, one, we need to know what the property is and the cost of the property. And then we also need to know what program fits the borrower the best. You know, are there better rates with FHA than there are conventional? You know, what is it that the borrower is looking to do? Where is the property, and what fits their unique situation the best? There are also down payment assistance programs. What I will tell you is, with the constriction of the market, so because rates are going up, because gas prices are insane, because our administration is looking to do everything they can to curb inflation, a lot of our down payment assistance programs have gone away. They're just not out there anymore. They don't have the funds. They're not willing to infuse the economy with more money at this time. But there are still some down payment assistance options. And those are things that I sit down and go over with you guys in the beginning when we sit down to look to get pre-approved. So again, those are just some things that I like to touch upon, because that's what's available to you. But again, each person is going to have a very unique situation. These are the down payment assistance programs that are out there. Now, Home Ready and Home is Possible. Home Ready I really like because that is first time buyer, 3% down. Home is Possible and Home at Last rural programs, those are both down payment assistance programs. So again, we just need to take a look at what's available on any given day, as they're not guaranteed anymore, those down payment assistance programs. So unfortunately, we're seeing a lot of them go away. Any questions?
None at this time, Danielle. We're good.
Okay, I'm going to take a quick sip of water and clear my throat. I feel like the allergies are really bad this season, and my throat gets dry even though my nose is running. Anyway, TMI. Okay, there are some great tools through GNCU that you can educate yourself with, go through and find out what the benefits of owning a home are. This is a great resource. EverFi kind of does, you know, click through the slides, answer questions, and gives you an idea of the overall benefits and costs of owning a home. There are additional resources that we have with Greater Nevada, Balanced Financial Fitness. There are courses that you can take to kind of orient yourself into how your financial well-being plays into owning a home. So these will be posted, I believe. Is that right, Saray? We have them posted after.
Yep.
Perfect. And these are things, tools and resources for you to take a look at, you know, to sort of orient yourself and say, hey, is this something I should financially look into, or that I should be giving myself an overview on, and then does it make sense for me to go out and get pre-approved?
I absolutely love that. So yes, before we go into a more open question segment, I do want to let you know that all of the resources that we talk about or that I'm posting in the chat will be sent to you in a follow-up email. So you have these in your back pocket. And if you have any follow-up questions, I'll also be putting Danielle's contact information. You're always welcome to reach out to us. And I highly recommend these courses are completely free, whether you're a member or not. They're open to the public, and kind of sits down. We also have calculators and things like that. And so all of these little resources will be sent to you. And we do have some questions popping up, so I'm glad. And Danielle, thank you again for being here. You whizzed through that, but I still got so much information. No, it was so good. Yeah, it was a whirlwind of information, which I can't believe we covered all of that in 30 minutes, which is fantastic. So we can open it up to questions at this point, which again, like I said, it's one of the awesome benefits of being here with a mortgage consultant is we can get those questions right answered now rather than having to make an appointment later, which of course we welcome you to. But a couple questions. Not sure if this is the right time to ask, but we knew this question was coming, Danielle. Do you have any insight or opinions on the market and when the best time to buy is?
So I love this question because my crystal ball hasn't been working for years. So, but what I can tell you is a couple things. Here in Northern Nevada, we are in a housing deficit. We are about annually 6,000 homes short on an annual basis. Why? Because Northern Nevada, I believe, is unique, especially to even Southern Nevada, in that we have jobs. We are consistently seeing an influx from California, from various places, not, Oregon, Washington, because we have jobs. We've got, a Starbucks plant here, obviously the Teslas, the Panasonics, the Chewies. They're all bringing people in and employing them. So it's difficult for me to say when a good time to buy is. A good time to buy is when you as a borrower or a purchaser feel as though it's the right time for you. What's going to happen to our home prices with increasing interest rates? Again, we're at a $6,000 deficit of homes annually. There's still a demand in the market. However, with increasing interest rates, we're seeing some buyers fall out. So I think that we're going to see a little bit of, we're going to see the market slow. In other words, if I'm offering in the entry level price position, are there going to be 25 offers on that house? Probably not. Maybe more like 3. So I think that although interest rates are increasing, I think we're going to see a leveling out of house prices. I don't really see them falling, especially in certain price ranges, just because of the housing deficit that we're in. So it's a supply and demand sort of thing. Now, I see another question. It says, when you offer a home, when you make an offer for a home, should you offer over asking price? Now, that is a great question to talk to your real estate agent about. Again, because we're seeing a shift in the market. Last summer, there were lines out the door of homes that first came on the market of a dozen to 2 dozen people trying to get into that house to look at it. Now we're seeing that slow down. So that is a great conversation to have. Often your real estate agent can call the listing agent and say, all right, how much interest do you have? Do you have offers on the table already? And then being in that conversation helps you to make a better decision. And I think I saw a question in there. Is there any advantage to speaking with a mortgage loan officer prior to working with a real estate agent? 100%. So again, being a realtor for 20 years prior to getting into lending, if a customer came to me and said, I want to go out and look at houses, my first question that I'm going to ask them is, great, where's your pre-approval letter, or who is your lender? That's the first question I'm going to ask, because I'm not putting someone in my car, especially with gas prices today, and taking them out for an entire day, showing them a whole bunch of homes only to find out that they're not pre-qualified or pre-approved. So that's a huge one. Before you even, feel free to take a look out there on realtor.com, Zillow, whatever the case may be, but no agent is really going to take you out looking unless you're pre-approved. Any other questions?
I did want to add on to that. I was like, absolutely, get pre-approved before. In my home buying experience, I wanted to make sure how much I knew I was approved for. So I wasn't, that classic term of trying on that wedding dress that you can't afford. It's the kind of same thing. I didn't want to fall in love with a home to find out that I couldn't afford it. I think we do have one more, and maybe some typing, and we'll give it a few moments. But when you get a pre-approval letter, can you use that for all offers, or do you have to get a new one for every offer?
So I think that's a great question, because here's the thing. So let's say I write a pre-approval letter and you're pre-approved for 400,000. Okay, that's great. And it says address to be determined. In my mind, if I'm a seller and you're now offering me 375 for a home, but I see that you can afford 400 and I'm asking 395, what do you think I'm going to do as a seller if I know you're pre-approved for up to 400? I'm going to counter that offer because you're not offering me what I think my house is worth. So I think it's a great idea that if you're writing an offer, to have a, reach out when you're working with your real estate agent, always reaching out and having communication with your lender saying, hey, we're going to write an offer on this house. This is what we're offering. This is the address. And then I can then pull up the property taxes. I can find out if there's an HOA. I can give you a really good idea of what your monthly house payment's going to be, mortgage payment. So again, then you're tailoring that pre-approval letter to the offer you're writing, and you're not letting the seller know, well, I can afford way more than this, but I'm only going to offer you this right now to see if you'll take it, right? So I would think that updating a pre-approval for every single offer makes a lot of sense. And then I had another thought. Oh yeah, and again, I can tailor. I can look at that house, those property taxes, the property address, how much you want to offer, and give you a really solid idea of what that monthly mortgage payment's going to look like. And I'm not sure, I'm seeing some questions in the chat here, but I'm not sure which ones
Yeah,
I answered.
a couple more. I think we are left on can you please expand on how offering over asking price can affect my mortgage / how much I'm actually paying out of pocket for that house or on that offer?
Okay, so this is a great question. So you can offer over ask price. 100% you can. The lender, so let's say I'm offering 400,000 on a property that's 375. One of the things in getting a loan that your loan is contingent on is your appraisal, right? So a third party independent appraiser has to go out there, look at the house and say, yes, I think absolutely you should lend 400,000 to this borrower because this home was undervalued. You, Greater Nevada, can confidently extend credit to this borrower for 400,000. The flip side could also be true. I've offered 400,000 on a home. The appraisal only comes back for 375. At that point, the borrower has a decision to make. Am I going to go back to the seller and negotiate the purchase price down, or am I going to come out of pocket another $25,000 in order to purchase this home? The lender is only going to lend on the appraised, a percentage of the appraised value of the home. So for example, if you're a first-time home buyer, the maximum amount the lender will lend on that appraisal is 97%. If you've already purchased a home in the last 3 years, the maximum we'll lend on is 95%. If it's an investment property, it's 80%. So there's different factors, but that appraisal is huge. And so if you have the extra funds, you want to borrow against your 401k, you are like committed to purchasing this house, you can come out of pocket, but we're not going to give you more of a loan. So, and again, it's not going to increase your monthly payment if it doesn't appraise. You're going to have to come up with additional cash out of pocket. If it does appraise higher and it matches your offer, again, that's another conversation we're going to be having. How much more is my mortgage going to be? for every $10,000, depending on the interest rate, you're going to see your monthly mortgage payment go up by about 75 to 100 bucks. That's not 100% accurate. That's just sort of generalizing.
Thank you. I also wanted to put this question out there because I think I have it each time, and especially when we're talking about lending. What's an ideal DTI or debt to income ratio percentage when trying to get approved for a home?
So I did touch on that earlier and I went through it pretty quickly, but typically you don't want to go over 45%. In certain cases, you can go to 50, but that then is, again, am I still able to go out for my Starbucks coffee? Am I still able to go out to the movies now that we can go to movies again? So 45% is really sort of a threshold. If it's lower, it's better. But any higher than that, you're really sort of, I don't want to say putting yourself in a corner, but you're going to have to cut some things out of your lifestyle. You can still get pre-approved, but you're going to feel it a little bit more because, again, remember, we're taking gross income prior to you being taxed or paying your health insurance or putting into your 401k. We're taking your gross income and then allowing you a mortgage payment, 45% of that. That is prior to sewer, garbage, electrical, water. So again, that is something that each individual borrower needs to be comfortable with. You know, we can go to 45%, but what are you willing to sacrifice to get this home? We don't want you to be house poor. We want you to own the home. We don't want the home to own you.
I love that. And I absolutely love this next question. Thank you for throwing this in the chat. What's the ideal credit rating? What do we look for? Maybe what's the minimum? And if I don't meet that, can you help me get there?
Absolutely. So minimum credit score for lending is 640. Now, if I've got a 640 credit score, am I going to get the most awesome rate that's out there? No, I'm not, right? Because there's more risk associated with a lower credit score. We used to be able to do as low as 580 on FHA loans, but again, with the constricting of the market, with us battling inflation, the minimum credit score limit is 640. Anytime you can get, so I often counsel borrowers, if you can get from 640 to 660, that's going to help you. If you can get above 680, it's going to help you even more. So credit, the highest credit score you can have is 850. To this day, I have yet to see one. Anything between 760 and 850 is considered excellent. There's no difference in rate between 760 and 850. You are an awesome borrower. We're going to offer you, you know, the best rate we have for that credit score. Again, so the closer you can get to 700, the better. Now, if you're sitting at a 640 and you're like, what can I do to increase my credit? There are a couple things you can do. Number one, if at all possible, keep the limits on your credit cards at 30% or lower of your credit limit. So if I've got a credit card that's got a $1,000 max on it, I want to keep it at 30% or under. That is going to help my credit score, right? If you have a credit limit of $1,000 and you're at $999 or even $1,001, that is really hurting your credit. So if you can fix that, that is probably going to be the best thing you can do. And the other thing, which is a little bit of a trade secret, is if you really want to increase your credit score, and I've done this, I've seen it work, even for borrowers who don't have credit established yet. If you have a family member, mom, grandma, dad, Aunt Betty, Uncle Joe, somebody who has amazing credit and has had, a 20-year history of credit, has very low monthly credit card statements, if you can get added as an authorized user to their oldest trade line, you don't want the credit card. You just say, hey, mom, can you add me to your oldest trade line, one that you pay off every single month, that you don't really necessarily have a high balance on? Could you add me to that as an authorized user? I don't want the credit card. Shred it when it comes in the mail. Mom's good 740 credit score then reflects back on the borrower who doesn't have established credit or has poor credit, and it's a one-way street. In other words, my credit then doesn't go back to mom. Only mom's is reflected on me. I've had this happen in a situation where a borrower had zero credit established. His brother did this for him, and within 45 days, I was able to get him a new updated credit score, and we were able to refinance his house. So trade secret, huge way to increase your credit score. And then, so I think I answered that question in regards to the ideal credit rating. Anytime you apply, myself, anyone applies for credit to be extended to me, so I'm applying for you to give me credit, that is going to be a hard inquiry. A hard inquiry, depending on how many trade lines. So like, for example, if you're buying a car, typically only one trade line is pulled. For a mortgage, always required 3 trade lines. Yes, it's going to ding your credit anywhere from 5 to 15 points, somewhere in there. But the minute you start making those on-time payments, your credit score is going to go back up and probably go up above what it was before. So, but anytime you apply for an extension of credit, that's a hard inquiry. When credit cards come to you and say, hey, do you want to update your income so we can increase your limit? They're going to do a soft inquiry because they're going to you to say, hey, we can offer you more credit. I don't think that that's always a good idea. If you have too much credit that you're not using, I've got, $15,000 or $20,000 limit on my credit card, that can hurt you too, because now you've got credit that you're not using that you could go and, go crazy with. That presents risks. So you don't ever want to have too much credit card limit. Again, something where you can live, but not go over 30% of the outstanding credit limit. That's what helps your credit.
All right. Thank you so much, Danielle. I'm so glad we had questions for or after the presentation, time for those open questions, because I think we covered a lot more information. So thank you so much. But I think that leaves us. I haven't seen any more questions pop up, and this gives us a little bit of time to maybe snack and take a break before we go back to work from our lunch break. So I just want to say thank you again, Danielle, and thank you all.
One more thing, Saray.
Oh, please go ahead.
People can also get a copy of their credit report from annualcreditreport.com. I don't know if you could type that in the chat, but
absolutely
annualcreditreport.com. And the cool thing about that is if you go there, it's for free. You can pull all 3 trade lines at once, or you can pull 1 trade line at a time. I tell people who are monitoring their credit, pull 1 a quarter, so you kind of have an idea where what's on your credit report. This is, again, will not hurt you if you pull it. So instead of pulling all 3 on an annual basis, pull 1 trade line quarterly, so you kind of know where you're at if you're working towards improving your credit. So I forgot about mentioning that. And then I think that was the only other thing I had.
No, that's a great one. And thank you for putting that in there. That is one of the resources that I will put in that post follow-up. We highly recommend it. This is the link, the annualcreditreport.com. None of those other ones. This is the one that you can get for free, all 3 of those reports. And I highly recommend taking advantage, at least. Yes, like Danielle said, do those quarterly. The yearly is also great. If you don't take a look, how do we know what's on there? Keeping an eye out for things that we don't recognize. So for many reasons, I recommend doing this free annual credit report.
100%.
And then on top of that, I can absolutely add some information. We have some credit building tools here at GNCU. I have used them personally, and they worked really well for me. And I can put some information about if you're interested in building credit on the home buying experience. So, but I think this does leave us. Danielle, let me know if you have anything to add. And again, please keep an eye out for that follow-up. But thank you guys all for attending our Greater Financial Wellness series. For those of you guys that would like more information from Danielle, again, we'll be sending out in a follow-up email along with a survey. If you're interested in learning more about these webinars, go ahead and check out our website. It's gncu.org and search for Greater Financial Wellness Hub. Thank you all. Have a great day.
Have a good one. Thanks for having me. Always a pleasure.
Thank you. Bye-bye.
Bye.